All right, guys, what's going on? This is Ryan, aka Cantering Clark, and I'm your host. And the reason I'm being redundant and mentioning what many already probably know is because we have a constant influx of new members every week, and I just want to keep everyone up to date. Okay, introduce myself, right? Um, we really enjoy the community that we've built. As the saying goes, not to be corny, but I think it's an old African proverb: go alone, you go fast, okay, but go together, you go far. So that's what we intended on doing when we created Black Roots, all right, to build a platform that can grow as a community and where we could basically help each other, right? I'm constantly seeing you guys become more and more active on the platform, and I think that that's exactly in keeping with what we originally intended, right? For it to be an active community, right? So it's not just a classroom setting where Josh and I are instructing or dictating by any means. This is a peer group. These are people that I consider friends. All right, so if you're new, welcome aboard, and we all have a lot to learn, and still learning. So today I did a webinar or an interview with Dale Pinkert rather, of Forex Analytics. He's pretty much a legend in the trading space. So if you want to check that out at forexanalytics.com, we spent a little bit talking about order flow and Bitcoin and just the way in which I've been trading, as well as the path I took. So again, with the win, order flow. All right. So the most important things to me, all right, in regards to trading Bitcoin is to identify the path of least resistance, okay, who's in control, all right, and any type of um, it goes without saying, because when you identify who's in control, you could identify where maybe there are trap traders, okay, traders out of position, offsides, and so forth. So to identify where possibly the majority of the market sits in terms of what position it's already in prematurely, okay, that if provoked slightly and pressured, all right, as everyone goes for the door, okay, will spill either upward or downward. So if shorts have to go to the door, meaning if they all have to exit at once, that's when you have a squeeze upward. If longs have to exit all at once, that's when you have squeezes downward. So Bitcoin, you know what? It has an incredible narrative, right? So from the lows of 3,100, okay, all the way up to the highs of basically 14,000. All right, depending on what chart you're on, how far the wick went. Okay, tremendous move, right? So a juggernaut, okay, when it comes to trends. But this is the nature of an asset that has a really low float, meaning it has a really low supply. So limited supply, okay, a lot of demand, okay. When a lot of that demand pours in at once, you have a really reflexive asset. And I was beginning to assume this move here, and I mentioned it before, could potentially have been a melt up. So a melt up is when you have the last of retail investors that are on the sidelines chasing a price upward. So that's what you have when you have one of these exhaustive moves upward. Okay, you get that retest of the high, and then this is a technical double top, right? So I think I was still bullish over here, right? So I was still bullish over here, anticipating that we could potentially get one more leg up, right? So one more leg up ultimately before correcting and doing what markets do. All right, they move cyclically. Okay, they move in cycles, okay, on the higher time frame, on the lower time frame. Okay, it's essentially just think about what it is, okay, and why a trend is strong. So why is a trend strong? Well, a trend is strong like this with pullbacks that are shallow because not a lot of people are taking profits, and the few times that people are taking profit and selling, there's someone to buy that up right away. Okay, so when we see a trend that maybe does this shallow pullback, bought up, okay, maybe this dip is a little bit deeper, okay, less bought up, okay, and this final dip is exhaustive, spikes, and then comes all the way down, okay. What does this look like? This essentially looks like it hit something, right? So it looks like it hit something. Well, it hit supply, right? So demand did not follow all the way up the same way it did previously. It did not keep up the momentum. So Bitcoin is a trend follower and momentum trader's dream. All right, so when it trends on the higher time frame, if you go off of a simple moving average strategy, okay, and you're willing to step away from the chart and put a loose enough stop on, okay, where you don't over position size and over leverage, you could really take advantage of a move just off of something like, let's say the 20 moving average, right? So the 20 moving average on the daily, okay, you could have been in this move pretty much the entire way up, okay. Sold when we crossed below, bought when we crossed back above, but you could have bought this in confidence after we had a major breakout and we were above the 20 if you were going to execute on this strategy consistently. All right. Part of the reason why traders fail in cryptocurrency is because they're executing with too much leverage and they can't give positions the adequate amount of space they need to breathe. So they can't put on the proper stop. So if you just go into your indicators, all right, and search indicators and pull up a volatility stop, okay, this stop that you'll see indicated by these dots is based on a multiple of the average daily range of movements. So think about it as, it is maybe 1 or 2 standard deviations away from the current price movements. So anything that falls within the norm is not going to stop you out. When something is a multiple, say 2, 3 times, depending on your settings, okay, that's when you're going to be stopped out, and that would be considered a volatility stop. We have a whole roadmap on this. We have a bunch of videos on volatility stops. So most traders can't take advantage of the moves that occur in crypto because they over leverage and they put on too large of a position. So if price moves adversely against them, even if it's a healthy pullback, okay, if it's a healthy pullback and they're long, or if it's a healthy rally and they're short, they can't take advantage of the movement that follows because they're stopped out prematurely because they put on too large of a position. Okay, you can't be greedy. All right, you have to try to hit base hits. So I know a lot of our members don't live in the United States, but baseball is the most popular sport in the United States. You have to go for base hits. Add up base hits, okay, and your runs will score in. Okay, so stop trying to hit home runs. Okay, what happens is you'll have a period of, let's say, some really great wins, okay, and you'll start to feel really confident. But if you're still over leveraging, you'll have what are considered negatively skewed returns. So what that means is that you'll have a bunch of great returns, and then you'll have one that just wipes out everything. Okay, so this is more in line with gambling than anything else. So Bitcoin trends really hard. Okay, trends for a long period of time, and then it corrects like anything else. Okay, and when it corrects, it tends to do the same thing it did on the way up, and it corrects a lot deeper than people expect. And this is a really small market that has only been around for such a long time, and this is only the BitMEX chart, but it goes on obviously till 2011, 2010. And that's all the sample size we have to go off of. This can do a completely different pattern than we expect. And the fact that we all have so many eyes on charts and previous patterns, okay, might be setting us all up for failure because we're expecting the market to occur just as it did, okay, as if it's going to grow logarithmically into the future. What needs to happen is new investors constantly need to come in, okay, for this thing to grow. We could trade this around and cause this movement just with the pool of people that we have within the actual crypto space right now. So maybe a small percentage of people entered in the space. Okay, I know a bunch of people who were not interested in crypto at all and entered within the last few months. So that is a positive thing. And this does likely have the potential to continually positively drift up, even with not too much action, just on small accumulations through retail investment alone. But for that large outsized move to come out, we need that that frenzy, right? And we don't have that yet. And what drives those frenzies? Well, for example, after a move like this, where everyone sees that we had this major move, okay, we have a major correction. If Bitcoin has somewhat of a bottoming process again and then pulls the same move it pulled over here, not only do you have everyone who's in this move, okay, who are watching that and they're likely going to be in the next move, okay, you have people that saw this play out the way it did, okay, maybe did not enter in. All right, why is there a sewing machine there? Thanks, wife. So did not enter in, all right, on the last one, and therefore they're not going to miss this one. Okay, it's about to break an all-time high, okay, or it's about to break the previous high of the structure. The trend is clearly true, and in this case, they'll likely hop on two, and that's when you might get, that major rally, that major bull trend upward again, okay, after this correction. So nothing is off the table. It's important to remember that. Nothing is off the table. Okay, don't be surprised. Anytime you trade Bitcoin, you have to keep that in mind. Don't be surprised. Don't marry into the narrative. Okay, I was assuming this would correct potentially a little bit more here and then test higher again. Right around here when I started seeing these really clear divergences, okay, what I call odd lot order flow, what I call, I hate to call it dumb money, dumb order flow. All right, you see a lot of these divergences pop up, like I said, between passive order flow and active order flow. And it's small orders. And it's the last people trying to jump on this, considering, or rather assuming this is going to keep continuing upward indefinitely. All right, and they are offsides. They're late to the move. It's too late. They bought the top. Okay, they bought the top for this move. So you have to divorce the narrative, right? You have to stop marrying to the narrative. Okay, you need to do, and this is exactly what I've done from square one. Okay, I have invested in what I consider the amount of Bitcoin that I want to own, and then I trade around it. And I will add at value areas, but I have the amount of money that I have in Bitcoin. Okay, it represents, honestly, it represents a small portion of my overall investments. All right, it is the one that I am most excited about. Okay, but I am not over leveraged. Okay, in my own investments into Bitcoin versus everything else. All right, I trade around Bitcoin. All right, and everyone should consider that sort of operation as well, where you put in the amount of money you're willing to lose. Okay, it's a cliche and it's over repeated for a reason because it's true. Okay, put in the amount of money you're willing to lose, and then you'll be able to divorce the romanticization. All right, you'll be able to just trade this thing. All right, in a directionally agnostic manner, meaning you're not going to care if it's going to go up or down. All right, if you traded both sides of the market, if you took advantage of some of the stuff that we're teaching you, if you use something like Bybit or BitMEX or any of these leverage exchanges, you could trade both sides of the market and you could make a killing if you are the person who is willing to let go of the idea that price is just going to continue upward. You could have been killing it in shorts already. So keep that in mind. This thing bum rushes its way up, okay, to, ridiculous altitude, and it does the same way on the way down. Same thing on the way down. It does it much more swift manner on the way down. That's just generally the way that markets work. Okay, markets are easier to long, and I'm sorry if I'm just talking too much versus getting into what I'm going to get into in a second. But markets are easier to long. Now, even though the derivatives exchanges pretty much rule the market, markets are easier to long. Why? Well, the first thing you can do to enter into a Bitcoin investment or to pick up spot is long it, right? So easily, all right, that is the most accessible thing to do, to long a market. Okay, so anytime that a market corrects to some degree, you have a level of panic, all right? When you have a majority of people that are already long, you have these extremely swift moves down. So I don't think I need to go into the mechanics of how that works, okay? And I think that will pretty much do it for my little diatribe or rant. So divorce yourself from the emotion, okay? Forget the narrative. Put in, okay, over a period of time, maybe dollar cost average in, but we're interested in trading, okay? We are interested in trading because when this thing moves, okay, moves in an extremely formulaic way, all right? It really respects support and resistances, okay? It really, when it trends, okay, it trends with a lot of strength, okay, upside and downside. So, what did I say earlier? I said that when I'm trading, I'm looking for who's in control. Who's in control? Okay, who's potentially off sides? Okay, where is the path of least resistance? Okay, so we immediately have to ask the questions, when we look at the chart that we could likely identify, with the naked eye. Okay, what direction is the trend in? All right, what's the higher time frame trend? Well, the higher time frame trend has been up. Okay, what is the intermediate trend? Well, 3 highs basically here. Okay, corrective sideways period of movement. All right, where we are compressing within this range for 3 months. We broke down. Okay, so as I mentioned, all right, this must have been now a month and a half ago or a month ago. The first thing I said, all right, okay, if we broke down, and then saying I said it after is if we break down, okay, we have to consider that we're breaking down from a period which we ranged for 3 months. Okay, so instead of price moving up, it shows down. Okay, so for all intents and purposes, now the trend is down. Okay, we're not looking for longs. We have to be looking for shorts. And when you're looking for shorts, you're looking to fade rallies, meaning when a rally occurs, you're looking to sell it. So some people didn't understand in the community what I meant when I said we're trying to reclaim an area. So what I meant was, this is the area we broke down from, roughly, right? So the area we broke down from is there. That was our support. Okay, don't be surprised if price, what does it do? It tries to come back up to this area. Now, why does it try to do that? Why is that potentially there to be set up? Okay, first things first, when it comes back to this area, this is going to be an area to short. So when it comes to try to reclaim this area, if you have staggered positions with limit orders, all right, whether or not you're going to try to market execute here, whether or not you're going to be trying to do what I said about taking advantage of the backside of the move. So if we look here right now, I mentioned take advantage of the backside of the moves, right? So what does that mean? Well, instead of trying to short with a limit order here, anticipating that it just rejects right away and comes all the way down, what we could do, considering price might mosey its way up, we could wait for a rejection, okay, wait for consolidation, all right, and then short the break of here or the retest of what low occurs right here. So just to draw this in a more clear manner, okay, the backside means rather than try to take advantage of, say we have a move like this. So rather than try to short each one of these tops, okay, why not wait for the rejection, okay, where price likely rejects, probably tries to come back up and then form some type of structure, okay, whether or not it's a structure like this in which we short this break, okay, that's the backside of the move, or whether or not it's, something like this where we do have a high, we have another high, and this rejection comes below this high. So at that point, you might want to consider the backside right there. So entering in a short there, rather than just trying to catch a short here, because likely if you catch a short right there, it'll be the initial rejection. The price probably will come back up to retest. That's a possibility. That's on the table. Now, why is it on the table to try to reclaim this area? Well, if someone was short from here, okay, or say they were short from here, they're probably going to take profits at some point, right? So what happens when someone shorts and then takes profits? Well, they're a buyer of the market. So they buy in, okay? You have longs that are looking to, you have think about the type of strategies that are taking place. You have shorts that are closing out, right? So that's not a strategy, but that's a mechanism. And then you have traders that are strictly traders who buy mean reversion. So they're saying, well, this is a big move. I want to buy mean reversion. And what that means is a reversion of the mean. They want to buy something that would correct, such as a bounce. So you have the people that are buying with a bounce, right? So you have the people that are closing out their shorts. So we have a little bit of movement up, right? And then you have people that are buying swing failure patterns. So you have three potential setups, okay, to occur all at once, all right, to give this thing some legs. So more than likely you see some type of attempt up. If you don't, price is extremely weak, well, that's, just didn't occur that way. Okay, you could potentially see this where it sets up like this, breaks down right here, retests, okay, and then moves lower. So before we get into the actual order flow, again, I'm going to hit home on what we see and what we have seen this entire time. So this was here, okay, this was here. I'm pretty sure it occurred right here. I'm not completely certain. I would have to go back through my Twitter wall and see exactly where I was calling these specific divergences. Okay, I remember specifically sharing my Trading Technologies platform and showing this, okay, because it was easier to see on that platform versus a footprint chart, right? For most of the people that view my page, it was easier to see a divergence in a line. So we saw that there was a pretty damn big divergence here, okay, here, and then absolutely right here. Okay, we also had one right here, okay, which we pointed that out, okay, and then we just had one here, all right? So order flow is my bread and butter, okay? Order flow with price action, okay, and trading horizontal ranges. So support and resistance, okay, or levels trading. So order flow allows you to have some type of, or understand some type of context, okay? You're not just seeing the candles, okay, and not seeing anything that goes on within them. Okay, we're going to see when there's imbalances, okay, when there's a large amount of aggressive order flow, okay, when maybe there's potentially not a large amount of aggressive order flow, but still there's action with the candle, meaning that all the order flow or all the movement was, maybe not necessarily due to a ton of traders lifting the offer, hitting the bid. It could have been due to liquidity reasons, strength on part of the limit. So this gives us an idea, again, of who the heavier hand is, because large traders, the people that are moving the market, okay, across all markets, are going to be executing typically with passive order flow, all right? And one example of passive order flow was essentially, if we look back at how the monthly worked. So let's just map this chart out right now. So put the Clark indicator on because it's going to actually put on the monthly open. Okay, we'll take off the bar color that shows us above the 20. All right, and now we have the monthly open. So monthly open occurred back here, Okay, that was support right here. We flip below. It served as resistance. So the monthly open is used by traders who execute with passive order flow or on, through the limit order, for example. In that, if you had a trader who was short here, short the open, they're anticipating that, the price is going to retrace, okay, or come back to the open. They're a large trader. They're trying to put on a large position. They might put a position on across a major area like the monthly open in order to fill it as it moves along it, right? So, this is more useful or has been used for a long period of time in traditional markets, and we can see that it does often work in cryptocurrency as well. So let's look on the higher time frame. All right, let's take this out, pull out our fixed range, all right, for this entire structure. Okay, now why did this level serve as a support? Well, you have this daily structure right here, okay, and then, well, this is the 2-day, still the same thing. Okay, so daily structure down here, okay, another thing, the edge of this ledge, all right, oops, oh shit, excuse me. I have to get better at using TradingView because when I'm trying to get rid of a drawing, I end up getting rid of all of them. So this right here, let me just get a horizontal bar so you can see where that extended to. Okay, this low, okay. Now, where was this low of this structure? Okay, match this low with the dashed line. Okay, this low. Okay, these lows, right? So these lows of this range, okay, this range that we are moving sideways, okay, from the end of September, okay, you can see the volume profile of that range right here. That's a large node, right? So the ledge, okay, is going to be the outermost area that price respected. So here's the ledge, all right? You'll see that typically when price moves from one volume node to the other, okay, it'll move through the gaps quickly. So the gap was here. So basically, where there was less of a volume profile, right here, okay, and then where does it peak out again? Right here. Okay, so you could see that is exactly where price staggered. Okay, that's the first area that price came down to test. That was the area where we had this swing low in the day on the daily right here in this structure. Okay, so for that reason, if we're looking at the volume profile in anticipation of prices moving lower, potentially this one small volume node, I wouldn't really say that there's too much meat on that one because that is likely due to the fact of this retest down here, all right, or this low wick, okay. Probably just an anomaly in that sense because price moved up here pretty quickly. It's not like it spent any time here. So in that case, this is the next major ledge, okay. This is clearly this whole area right here, okay. We can expect that if price clears these lows, all right, it's going to do exactly what it did up here, all right, just as fast, all right, unless some unforeseen entity steps in the middle of a knife catch, okay, and it doesn't make sense for them to do that. It makes sense for them to wait for price to come down to an area where it was valuable once before to buyers and sellers. So these areas represent where buyers and sellers, okay, thought price was important. Put it that way. That was where the auction occurred, okay? And you'll see that the volume profile, when it's even, when the structure is like this, okay, and it's a range, the volume profile will look like sort of a bell curve, okay? And you can imagine why that occurs. Well, so between this one standard deviation, okay, or this normal range right here between the bell curve, okay, I think it's like 68%, okay, we'll have a majority of the trading volume within that. So this is a really balanced one, okay? And when this occurs, okay, just think about it like this. When price moves outside of the standard deviation, okay, and it moves into the tails, that's when you get breakouts, okay? So not to think too out there about the volume profile being somewhat similar to a distribution curve, okay, or the bell curve in that sense, perfect distribution. But that is what it looks like, okay? Think about when it looks like this, it means that buyers and sellers really found an equilibrium or balance between a structure. Typically, you don't have that. It looks a little bit more wonky. All right, so I don't know if you can tell, but wonky is one of the words that I prefer to use when I don't have a better word to use. So that's what we're looking at. We're likely looking at this area if this area doesn't hold. Okay, so let's look back at the structure now, right? And let's get back into what we've been trying to drill home and what will be a really, really important part of our trading workshop. So volume profile, okay, where were buyers and sellers interested? So when price moves from one range to the next, okay, buyers, okay, price is going to be, if the auction market theory is that, price is going to move to an area, okay, where buyers and sellers were interested. Okay, if price is dropping, it's going to find an area where buyers are willing to step in, where buyers are more interested. If price is moving up, it's looking to find sellers. Just think about it that simply. Okay, in these areas where price consolidates, that's where buyers and sellers found balance. So we're going to typically be moving. Okay, so if we consider that, this area right here, that's not the best representation because the range, I should include more of the earlier portion of this. But, just imagine that if I zoomed out, this looks like this for volume profile, this looks like this. If price broke above here, it's likely going to look for the next area of liquidity or the next area, okay, where sellers would be interested, right? So it's going to find the next balance area. So this is the typical behavior that we see in markets, okay? If you subscribe to the auction market theory, it's something that I do. So if we look at this structure, okay, we had from here to here. Doesn't matter if you have this candle or this. I know I left that one out, basically. This one right here, it doesn't really matter. Okay, this line through the middle is the volume point of control. This is the area where the most trading volume took place, the highest volume node within this distribution. Okay, we have somewhat of a ledge right here. You can see that price came down to this area. Okay, now mind you, I extended this all the way here, so this is included in this right now. Okay, but if we go pre-breakout, let's look at what this looked like pre-breakout. Okay, so pre-breakout, all right, so pre-breakdown. Okay, so still same thing, right? So this area you can see through where price interacted here, okay, has served as support and resistance this entire time. Now, mind you, that that occurring has helped this become the volume point of control, since again this is extended to the end. So if I pull this back though, you'll see that it was still in the same spot, still in the same spot, okay, still in the same spot for the majority of the structure. So price respected this volume point of control, okay, the area where buyers and sellers were most interested, okay, where the area where most trading volume took place. This is basically, it's a support or resistance depending on what level you're trading it from. And this is something that not enough traders use, okay. I think it went through a little period where some traders were using the volume profile, okay, but they weren't using it on small structures, they were using it on the larger movements. So this is the point of control, okay, so we fell below that point of control. The squeeze upward, we were using this as support, but the first area we rejected from, okay, if we just open up another point of control or volume range, right? So volume profile, excuse me, from this rotation to down here. So from here to here, okay, that low is the support. Oh, I'm on Bitstamp. I'm like, why is that volume does not make sense? Excuse me 1 second. There we go. So this is the volume point of control, okay. I have to redo this now because to do it up to this point, okay, sorry, there we go. Okay, so we're trying to talk about it before it broke down. So because as this moves along, it's going to recreate this volume profile, and we don't want to keep this in because we're talking about why this set up to break down, right? So what we were looking at. So again, from this rotation to here, okay, so this was the volume point of control for this rotation. So for this structure up here, this is where the most volume took place. Go figure, where do you think we were rejected from? This area, right? So we were squeezing between here, okay? We were finding resistance where we once found support at the monthly open. Okay, so these are important things to pay attention to, right? But what side do you pick, okay? When something happens like this, what do you have to consider? Well, the higher time frame trend now is down. Okay, the intermediate trend is definitely down. Again, we broke down from this massive range. So you should probably be looking for shorts, but like I said, most traders aren't going to be trading properly with the right amount of size, and they won't be able to put their stop up here. So you have traders trading with high leverage, okay, and their stops are right here, and their stops are right here, and right here, and so forth. So again, where do we go from here? How did order flow, okay, come into, how is order flow important, rather? So order flow is important, okay, if we're looking at this whole structure now. So let's go into when we broke down from here. So why did we originally break down from here? So if we're going to look at, well, I'll draw this out first, and I'm going to show you, well, actually, I'll show you on the, let's go to Bybit's testnet real quick. So again, let's This is the test net. All right, I have about a little bit more than a tenth of Bitcoin on it. So essentially, again, what is active order flow? So active order flow is when you actively use market orders, right? So just think about active orders. Active order flow, aggressive order flow is when you're lifting the offer, meaning you're buying right from here, or you're hitting the bid with a market order. So market order, you're paying more money, you get this liquidity right here or right here. Okay, you're not specific about a price, you just are specific about making sure you get executed. So this is an aggressive way of entering the market, right? So that is active order flow. Passive order flow is when I use a limit order, I place an order on the books. Okay, I'm providing liquidity. Okay, if you're going to be putting on a large position, okay, if you're a large trader, you're not going to be using market orders for the most part, because unless you're trying to push the market around, it's going to cost you money, it's going to move price, it's going to reveal your intentions. All right, so understand that first. So a the delta is the difference between the sum of executions, okay, or the cumulative volume delta is the difference between the sum of the executions at the offer and at the bid. So, or at the bid and at the offer. So finalized executions, market orders, okay, it's going to show you whether market buys were more aggressive or market sells were more aggressive. So is this important because it leads the market? No. All right. When it matches up with passive order flow, that's when sharp moves happen. So when the book is really heavy and price is moving down through market orders, okay, and the limit or this is stacking up and not letting price move up, okay, yeah, then both sides are in tandem, right? So the both sides are working together. But when we see that, for example, this looks like there's not a lot of pressure, okay, and that there's really aggressive buyers, okay, and the volume delta, okay, the cumulative volume delta is, if we have a price chart, if you have a cumulative volume delta on Tensor, for example, uh, if you had it, it would show the sum of executions as a line, and they would typically, okay, they would somewhat resemble price. So you'll see that, for example, if it was behind here, it would look like this. It would somewhat follow price. So if you saw, for example, that over here, it went up, for matching this structure, it followed this high right here, okay, but then right here went all the way up, right? So for this point, it was going up, okay? Traders were aggressively buying in, okay? They're aggressively buying in. It's not leading the market, though. It's not that price follows this. You need to look at price first, okay, and then this. So what was price doing? So I'm going to draw out real quick what we're going to show you on this footprint chart, just so you have an idea of what it's looking like, okay? Not too many platforms offer the cumulative volume CVD indicator, okay? TT does, Tensor does, okay? And just to draw this to give you an idea for the instruction standpoint, if you log into Tensor, you can see this line, okay? What it showed was this point right here, the cumulative volume delta followed with this high, okay? But then a lot of buyers were stepping in, and they're odd lots. So odd lots means smaller orders, okay, but aggressive buyers at market, okay? But the delta went up, all right, was positive, okay, but price just stayed flat. So what does that mean? That means that the heavier hand is right here, okay? The same way it happened back here. This moved up, and this went up like that, okay? Price stayed flat, and the heavier hand was right here. Okay, so why would a heavier hand be right here? Well, it's probably a large entity using limit orders, okay? Typically hidden limit orders or iceberg orders, things you're not going to see on the book, to fill their short positions. So you're providing them the liquidity. Okay, so when traders are looking at this breaking out, okay, they're going from one small structure to the next portion of it and looking at that as the breakout, like, oh, if we break this high, that's a breakout. It's not, because typically you're going to want to see a structure like this painted and then break it with a new structure. They're buying the break of this peak, okay, anticipating that if we break that, we're going to move higher. What they did is they bought right into someone's liquidity. It suppressed price, okay, and then we had this move down. So that's been the whole case with this divergence between order flow or cumulative volume delta and actual price action, okay, or the divergence between aggressive order flow or active order flow and passive order flow. The entire time, every single time that these moves have occurred, that has telegraphed it, okay, and that is how I've been able to spot these things. And it almost like it's been kind of a joke lately, because you see a lot of traders that are using the most complicated methods. It's like they have a what do they call that? thing that universities and science classes set up, and it's a bunch of mechanisms to get a ball to go across a room and do all these things. And oh, what is a Rube Goldberg machine? It's all these moving parts, and all you need to do is to be able to maybe identify through positioning, okay, and order flow, who is offsides. So I also use the funding because when something like this occurs, so say that, for example, we have a massive divergence like this, cumulative volume delta is going up, price is not moving up, and the funding is positive, meaning longs are paying shorts. Oh, it's over. That shows you where the positioning is right away. All these things add up. Okay, they add up with the fact that this is likely a rally. Okay, after a major breakdown, all these things confirm each other. Okay, to put it in your favor on balance of probabilities that this is going to break down and not break up. So that occurred right here too. Large divergence again, price not moving up, price retest. You have all these things to add up, right? So you want to just list every clue. Okay, support and resistance flip. Okay, price at this point, if we're looking at this from a structural standpoint, it's retesting what was support. Okay, it was rejected heavily. You can see that with the price action. All right, and then at this point, we're talking about this actually falling below the volume point of control. So now it breaks down. We're up to here. Okay, it's fallen below the volume point of control, and at that point, it's clear who is in control. Right, the bears are in control, and then all you had to do was, as I mentioned, okay, I said this a few times, that because these were slightly higher than the next, okay, the stops were staggered, and all you needed to do was break one to get the rest to rip. So what did this look like on the chart? What did this pattern look like of delta? Okay, so if this was price action, okay, the cumulative volume delta did this. Okay, what did that look like? Well, that looked like this. So here is the actual atomized or granular level, all right, of each 4-hour candle, okay, for that structure. So what we're looking at is this portion right here. So if we zoom in on the 4-hour, okay, we're looking at this. So we have an even structure across the top, okay. Nope, don't want to do that. Don't want to mess around. This has a really sensitive zoom. Okay, we have an even structure. Okay, this breakout right here all the way up occurred on high volume. Okay, very high volume in the beginning. Okay, a lot of heavy action with large orders. Okay, tapers off a little bit. You have negative delta here. Okay, not so much of a positive delta. And this is just the delta for each individual candle, meaning if there was more aggressive buyers or aggressive sellers in each candle. And then this wick right here. Okay, see, there's not a lot of volume that took place up here. Okay, relative to down here. Point of control is down here. Okay, the most volume occurred down here. This tremendous wick, okay, heavy rejection, right? So heavy rejection, and this is not only, just a heavy rejection, all right, in the form of a likely an order up here waiting for liquidity, right? But it also had, so clearly, we had a decent amount of market sells right here, all right, but likely this was a large limit waiting to be hit, right? So someone looking to get their fills right away. Okay, so again, this is the volume, heavy amount of volume. Okay, volume begins to taper off. Okay, this push up here, heavy volume. All right, but not a tremendously high delta. Okay, we have an imbalance up here, but price is rejected, comes back down. Okay, so what I actually want to point out, and you can see the divergence now, all right, with the actual figures, okay, is that here, all right, so this is the high here, this is a high here, okay. If we look at these highs as being equal, so here before pre-breakdown, so this is clear because this is the break right here, this is one of the first breaks, but here, here, and here, okay. So let's look at each candle. So cumulative volume delta, all right. This case, it's high. It's right after a breakout. It's including all of this. Okay. The delta for the individual candle is taking off of here, and that's why this is going from 191 to 185. Don't worry about that. Flat still, right? This is the high. Okay. High, lower. Okay. See that? So clear. This is the high. This is lower. Okay. This occurred at 543 million contracts. Okay. This is 390 million. All right. Good amount of buying activity in the market right here. Good amount of selling. Okay. Hitting the bid, lifting the offer, aggressive buying, aggressive selling. Okay. Cumulative volume delta though, 7.6 million. Okay. Let's go to this candle. It's lower. The cumulative volume delta here is a good roughly 6 times as high. Okay, 6 times higher. Okay, the volume is about 140, 150 million less. Okay, but even though price was rejected, okay, did not move higher. All right, if it had a higher delta, okay, and price did not move higher, okay, and the volume was there, all right, you can see there's aggressive traders lifting the offer, all right, so large traders lifting the offer, okay, but the largest trading amount, so over 1 million, it's pretty empty there, right, compared to this 56 million right here. So smaller orders, all right, but the major tell is the fact that relative to these previous candles, all right, where there's a heavy amount of selling, okay, this is market selling. So market selling is rejecting this. Okay, the limit is rejecting this. Same over here, less in aggressive order flow, more in the limit likely. But here, this is black because there's not a lot of heavy action going on right here. Okay, not a heavy amount of action. All right. If anything, much more buyers aggressively, right? The cumulative volume delta is much higher, but the price is lower. So what that means is that even though there were way more aggressive buyers, okay, they could not move the price up nearly as much. All right, so this immediately looks like one of those hidden orders, okay, one of those hidden walls, okay, that we are running headfirst into and providing liquidity to. And then from there, you have a massive snap down, right? So right here, this entire candle, okay, negative 79 million, okay, in terms of sellers versus buyers in aggressive order flow. And then we just broke down from that point. And we broke down to, all right, if we're just going to stay in talking about, structure and where we could look, we're breaking down to, if we go from this rotation, okay, this range right here before the breakout, all right, where's the next area again? Okay, you can see that this, if I just extend this right here, this is the volume point of control. All right, so we'll extend that. Okay, you can see that's the first area we bounced, right? So again, this is something that you should really add to your trading. Okay, become really familiar with volume point of control, become really familiar with volume profile, and the workshop should really familiarize you with at least a base level understanding of order flow, because that is literally my bread and butter with all of Bitcoin's movements. And it's not heavily exploited right now, so it's not a crowded trade by any means. It's not like you're going to see these returns smooth out over time by everyone hopping on the same bandwagon, right? So that's what happens with really simplified strategies. If let's say, for example, that everyone considers that a 20% pullback is a perfect trade to buy, right? So meaning for a mean reversion trade. Well, what happens is you have traders that buy the 20% pullback. And we're just talking about a mean reversion trade and how it gets smoothed out. So everyone buys the 20% pullback. Let's say that this is a 20% move, just for example's sake. Everyone buys the 20% pullback. Okay, it's an effective trading strategy. Everyone knows that. It has positive expectancy. Okay, I don't want to do that. I want to front run people. So I'm going to buy it at 18%. Okay, I want to front run them because clearly it's not 20% anymore. Okay, I'll buy it at negative 15. Okay, my mean reversion will be buy it at negative 10. All right, and then what happens? You end up suppressing volatility and you smooth out these return characteristics. So hopefully that was very informative to give you insight into what we saw right here. There was definitely a lot of aggressive traders lifting the offer, okay, market buying to no avail. All right, flat top, okay, ton of market buying, didn't do anything. At that point, we knew who's in control. And it's a person operating up here, and then they're not likely just looking to take profits after a move down here, okay, because we already have rejection here, already had a rejection here. This was all we needed to see to assume that price was, as we originally assumed, going to break down lower. So hopefully that was very informative, guys, and not too long. Okay, if you have any questions about anything that I said in this video, absolutely feel free to DM me. If you don't watch this video, shame on you. Just kidding. But you should be watching the videos. All right, guys, have a great night.